Last Friday, the S&P 500 closed up to its best week so far for 2019. The S&P 500 is now near the highest level since early October, after breaking through key resistance levels near 2815, where it failed several times. It is now less than 4% from the historic closing high reaching 2930 on September 20th, 2018. So what should we expect going forward? Well, let's take a look. Here are some key observations to keep in mind. Traders increasingly believe global central banks have their backs. With the CBOE Volatility Index, the fear factor, near the lowest level since October 2018, the stock market may have more to run. Bond yields continue to drop, remaining near the lows of the year. The new high list was littered with interest rate sensitive stocks such as utilities and REITs, and these tend to rally when rates remain low. In Europe and the UK, they've outperformed the US this month. Maybe the US will catch up. The rate of downward earnings revisions for the first quarter was intense from January through mid-February. The revisions have slowed recently and has essentially stopped last week. First quarter earnings are now expected to be down 1.5% for the S&P 500 according to Refinitiv. If earnings stay in that range, there is a good chance that earnings results for the first quarter of 2019 will be positive, and we may avoid an earnings recession, at least one that began in the first quarter. Taking a look at history, there have been three healthy corrections for the S&P 500 since the 2008 bottom. The S&P 500 corrected from 19 to 20% in early May 2011 to early October 2011. In 2015 to 2016, the correction was 13 to 14% and lasted about 9 months. This current correction is about 19 to 20%, and the length is yet unknown. This chart here shows the historical earnings growth, and it's interesting, so follow. We can see that the great financial crisis resulted in a 33% absolute drop in the S&P 500 earnings when looking at 2007 through 2009. However, the S&P 500 chart overshot this by falling 50 to 55% from October 2007 through March 2009. The S&P 500's earnings then rocketed higher in 2010 and 2011, recovering all of the drop in earnings. Yet, it took another 2 years for the S&P 500 chart to make an all-time high, which didn't happen until May 2013. In 2018, the S&P 500 earnings grew 23%. This is an estimate with 2 weeks left of reporting. And yet, the S&P 500 chart fell 4.35% on the year. 2019 is turning out to be a year of PE expansion, as the S&P 500 earnings may only grow mid to high single digits, and yet the S&P 500 chart is already up 13% year to date. So here is the conclusion. In the last 5 weeks, the year-over-year growth rate of the forward earnings estimate has tracked in the 3% area. Maybe this indicates that the S&P 500 chart is starting to bottom and that the earnings expectations for the first quarter of 2019 may be the low point. Now, let me preface. The S&P 500 chart may be starting to bottom. So, stay tuned because we're going to find out. For today, that's ChewDog Charts. Thank you.